reporting 2 coronavirus deaths April 7. Let's take a look at the markets. We are seeing the Nikkei now come online up 0.3%, a bit of a mixed picture across Asia. The topics also up 0.25%. Of course, we have seen slightly better than expected eco data out of Japan when it comes to core machine orders and the trade balance earlier today. We did have the Japanese Prime Minister announcing a record stimulus package of almost $1 trillion as well. The Japanese yen strengthening a little bit against the U.S. dollar. Take a look at how Korea is trading at the moment. We are seeing Korea under pressure today, down 0.5%. The Kosdaq also down 0.7%. We had seen the Korean won one of the big gainers in the last session. Of course, there was a lot of risk appetite despite the fact that the U.S. closed a little bit lower for today's session. The Bank of Korea decides tomorrow, and they may stand pat. Of course, they had emergency rate cuts in March. Heidi.
Yeah, and we are watching in this part of the world, just Sydney stocks trickling online, some downward pressure, resuming those declines now, with most of Asia set really to halt that 2-day rally after US stocks fluctuated in that volatile session before ultimately losing steam into the close. We are seeing downside in the ASX at the moment, also downside when it comes to the trading in the Aussie dollar as well. This, as we had just in the last few minutes or so, that lowering of the credit rating outlook from S&Ps from stable to negative, the rating though still affirmed at AAA. Let's get some perspectives on how this sort of the implications for investing in Australian assets. Saxo Capital Markets Eleanor Craig is here with us. Eleanor, great to have you. Just digesting the latest news. I mean, I suppose it was inevitable that Australia's credit rating isn't bulletproof after all. Could there be more downgrades to come, given that we're expecting the RBA really to stay where it is for some time to come? And how does this affect appetite for investing in Australian assets?
Yeah, I mean, certainly. So I think it looks like it's potentially only a matter of time before that sort of coveted AAA rating is downgraded, and that clearly affects demand for Australian bonds. I mean, that is largely playing into, I think, once this virus crisis is cleared and we're through the worst of it, the recovery prospects look somewhat downgraded within Australia relative to previous crises. For one, we don't have any sort of impending mining investment boom to rescue us this time around. And we also have a consumer that is heavily over-leveraged and swamped with household debt, which I think puts pressure on the consumption outlook for years ahead into any recovery that we have out of this sort of virus crisis. But I think when it comes to the action that we've obviously seen in terms of increasing that debt load, it's really a case of the rule books had to go out the window, right? The government and the RBA had to act quickly in order to alleviate this unprecedented supply and demand shock that we have ongoing globally. And I think in that sense, we've really sort of turned a page in crisis response and economic rescue packages.
Eleanor, one of the things to come out of Howard Marks's latest note, of course, a legendary Oaktree investor saying, you know, it's time to stop playing defense, right? You need to be offensive and opportunistic in your strategy at the moment. Do you think that's right? And does that sort of particularly apply when it comes to Australian assets if we consider that we might get a better economic recovery, a quicker recovery based on what happens in China?
Look, I think we'd actually want to maybe take the other side of that for now. I think at the moment, the rapid bounce back that we've seen across most equity else. Of course, the news has been less bad than anticipated. And so I think a lot of short covering has played into those recent moves, and these big swings are characteristic of bear markets. And of course, case counts and death tolls levelling off is great news for humanity, but the real economy effects show no signs of levelling off. So I would say the market had it right first time round. I mean, of course, monetary and fiscal policy support has been quick off the mark and diminished tail risks. But we would argue that what we've seen to date in terms of stimulus is really stabilization. And now at these levels, equity markets are actually no longer appropriately discounting the hit to earnings, dividends, and of course buybacks as well, and other second-order impacts that are yet to come down the line. And I think specifically when we look at the valuation correction relative to previous crises and historical averages as well, the risk-reward at these levels really isn't favourable yet. It's improved, but we don't see that valuations are outright cheap. So I think it's premature to ascertain that the negatives are sufficiently discounted. But I mean, the unprecedented nature of this crisis really means that uncertainty is rife and the range of outcomes is still very wide. And I think perhaps the only certainty in this case is that volatility will remain. So I think it's really a trader's market, and you want to be remaining nimble. And of course, if you're more of a long-term investor, you want to have a focus on capital preservation and not over trading and getting caught in the chop.
Yeah, and Eleanor, we are just getting some more details from the S&P's statement after they lowered that outlook to negative from stable, saying the Australian government debt burden will weaken materially, saying that substantial deterioration is seen when it comes to the fiscal headroom that Australia has, that the government debt burden will weaken materially as well. S&P saying that the COVID-19 situation has dealt Australia a severe economic and fiscal shock, and that large budget deficits, though, are likely temporary. They're seeing the government deficit to average 7.5% of GDP in the 2020 to 2021 financial year, and annual growth to fall to 1.3% in fiscal 2020. At the same time, though, kind of going off my previous question, we do have China reopening, right? The economy is almost back to 100%. We have the city of Wuhan going back to work as well, and travel restrictions and the lockdown being lifted there. How quickly do you anticipate China can potentially recover? And do we get that kind of tailwind being, talking about economies like Australia, like New Zealand?
Yeah, I mean, certainly it's an interesting point, and of course there will be a tailwind to Australia as a commodity export towards China via any sort of infrastructure spending stimulus that we see out of China in terms of promoting economic growth there. But I think, again, relative to previous crises, we're not going to see the sort of stimulus that we saw out of China in 08 or 09 and 15, 16. It's not going to be the powerhouse that really propelled Australia through, I guess, the GFC relatively unscathed in comparison to other developed economies. So in that sense, I wouldn't be taking too much optimism for Australia out of that. And whilst we've had this sort of consumption upgrade cycle within China being good for our services exports like tourism and education, I think that the conditions of this health crisis potentially mean that those sort of services side of the export sector are going to take longer to recover. And I mean, when it comes to China, we have to remember that China was a secular grower before this health crisis, and the economy was in a vulnerable period even prior to this global pandemic emerging. Those sort of longer-term structural pressures were weighing on activity levels. They were somewhat precarious as well due to the hangover from the deleveraging drive and, of course, the trade war that really took its toll on economic activity within China. So in that sense, the Chinese policymakers have a pretty hard task ahead of themselves in terms of stabilizing growth within China against that backdrop, and not to mention the added health crisis as well.
Of course, in China, we have seen a very state-directed economy, but now, even with fiscal stimulus being added all across the world, how do you trade a market where the government is so involved in deciding what sectors to boost and what sectors not to help out?
Yeah, I mean, it's again, a really interesting point. And I think you kind of make the point in your question, right? It is a market where we do have these pockets of policy support. And in that sense, if we were to look at China and in terms of their focus prior to this crisis, it's on avoiding the middle income trap, and it's on upgrading productivity via technology investments that includes sort of artificial intelligence and the likes of that. And I think that's an area that still will continue continue to receive a significant amount of policy support. So particularly for equity investors, those sort of areas are where you want to be focusing on, for sure.
So, Eleanor, what regions are you focusing on when you are trying to gauge the earnings impact of this virus outbreak? Does it all depend on how broadly the economy is affected in each different region?
Yeah, certainly. And I mean, I think one of the problems at the moment is we still don't know, I guess, the scale of the problem. We don't know how long these lockdowns are going to be enacted. We don't know at this stage whether we're going to see a second infection wave, how things are going to play out in the southern hemisphere heading into winter, and whether in the northern hemisphere heading into fall that we're going to see a resurgence in virus cases again. So I think that makes it particularly difficult in, I guess, gauging whether enough has been done to arrest downside on the stimulus front and in terms of appropriately gauging the hit to earnings. And it certainly makes it a case-by-case basis. But I think you have to go from, I guess, the underlying assumption that at this stage we don't see that equity markets have fully discounted those negatives. And we're expecting another leg lower across global equity indices in terms of the risk asset spectrum.
Eleanor, what would you have to see in terms of the level of infections and the amount of government action that's been taken on the public health side for you to feel more comfortable getting back in at the valuations that we're seeing right now?
Sure. So I think in terms of the sort of conditions for a true bottom within equity markets, you certainly want to be looking at a stabilization or flattening out of the infection curve. And I think in that sense, that will give investors a way to, or some more clarity in terms of gauging whether the measures that have been taken on the stimulus front are enough to support global economies. I think you want to as well see a peak in investor sentiment in terms of a peak panic, and I don't actually think we're quite there yet. So we've obviously seen a panic deleveraging throughout Q1, but I don't think that we've seen the retail capitulation that would be needed to sort of typically indicate the bottom of the bear market. We'd also like to see a weaker dollar coming through into the picture, and the Fed really succeed on bringing that dollar weakness down. I think you need to see volatility resetting meaningfully lower. Volatility remains elevated at the moment, and that means that alarm bells are still ringing in terms of the investability of the market. And in terms of other sort of various indicators, we'd like to see the financials to utilities ratios picking up as well in terms of adding risk.
Eleanor, thank you so much for joining us as always. AXA Capital Markets strategist Eleanor Craig there. Let's take a look at some of the movers when it comes to banking and financials trading on the ASX. We're seeing Westpac down by 4.6% in this early part of the trading, just about 15 minutes or so of trading. Westpac saying that no decision has been made yet on the first half 2020 dividend, that they will be announcing that decision along with their first half results. We're also taking a look at other major banks, CBA, ANZ, all down over 3%. Bank of Queensland, one to watch as well. It became the first Aussie lender to delay its dividend after the prudential regulator in the country told lenders to reduce payouts during the coronavirus crisis. Bank of Queensland saying that it would defer a decision on its first half dividend until the economic outlook would be clearer. Jerry.
And still ahead, concerns any OPEC Plus cuts won't be big enough to offset an unprecedented loss of demand. We assess the outlook for oil. Plus, signs of credit stress are easing in Asia, with gauges of default risk retreating from the highest level seen in a decade. More on that with SC Lowy CEO Michelle Lowy. This is Bloomberg.
another day of risk-off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
You're watching Daybreak Asia. I'm Karina Mitchell with the First Word headlines. President Trump may pause U.S. funding for the World Health Organization, attacking its stance on travel bans and saying it failed to sound the alarm soon enough about the coronavirus. Congress allocated about $123 million to the agency this year, and the president slammed it for being what he called, quote, China-centric. The WHO urged against blanket travel bans, saying they've historically been ineffective. Meanwhile, the UK has suffered its worst virus day so far, with the highest rise in deaths and Prime Minister Boris Johnson remaining in intensive care. 24-hour fatalities rose by 786, taking the overall total to above 6,000. The government says Johnson is in a stable condition, doesn't have pneumonia, and is not on a ventilator. He was taken to hospital Sunday after spending 10 days in self-isolation. China is lifting travel restrictions in Wuhan, the city where the coronavirus initially emerged. The city has been in lockdown for 11 weeks with millions of people kept at home. Trains from other cities have already resumed services to Wuhan, and the move comes after China announced no new daily virus deaths for the first time. Final travel curbs in Wuhan will be formally lifted later Wednesday. Global news 24 hours a day on air and on Quick Take by Bloomberg. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Sherry?
Karina Mitchell, thank you very much for that. We do have the latest lines out of Hong Kong. Breaking on the Bloomberg, Hong Kong extending social distancing measures to April 23rd. Hong Kong ordering the closing of beauty parlors and massage places. Let's bring in our Chief North Asia correspondent, Stephen Engel, with the latest. Steve, of course, you're in Hong Kong. You have seen those virus cases surging early during the pandemic, during the global pandemic. Things seem to be stabilizing a little bit. What's the latest you have heard?
Yeah, things have stabilized. However, they've had a number of imported cases. Most of the new cases that the government has reported have been those who have had recent travel histories. Of course, we know that the Hong Kong International Airport has been pretty much locked down. No foreigners or transit passengers allowed in. But that's taking steps staying closed until at least the end of May, which is already getting towards the end of the calendar school year anyway.
Steve, in terms of these moves towards an emergency declaration in Japan, what can the government there actually do under the declaration?
Well, of course, under Japanese law and their civil liberties laws, which are quite liberal, they cannot confine people to the homes. But under this national state of emergency, well, it's a state of emergency declared by the national government for areas including Tokyo, the surrounding prefectures of Chiba, Saitama, Kanagawa, as well as Osaka, Hyogo, and Fukuoka prefectures. It will be a 1-month state of emergency starting yesterday. So today, pretty much the first full day under the state of emergency. It's not a lockdown. It's more of an urging of or giving powers to the local governments to make suggestions to the people to stay at home. And under Japanese etiquette, a lot of people are staying at home, and also people are not necessarily going to work. This, as the number of cases nationwide has risen to nearly 4,000, 3,906. Number of deaths has risen to 92. So this is quite a sharp increase from just a month ago when there was very little testing and very few numbers, but the numbers have actually surged, especially in Tokyo in recent days. Shinzo Abe says if no intervention by these local governments, infections could reach 80,000 a month. So people are taking heed of this advice.
All right, our Chief North Asia correspondent Stephen Engel there with the latest on the measures in Hong Kong as well as Japan. We'll come up next. Crude on the rebound, but concerns, of course, still remain. Will any cuts come through from producers, and will they be enough? And how do oil rig workers practice social distancing? This is Bloomberg. Well, crude oil futures are rebounding. Well, WTI had plunged as much as 10% in New York, trading on concerns that any deal by major oil producers to cut output just won't be enough. We are seeing that rebound to the tune of about 5.6%. Sue Keenan is watching all the volatility. The decision from OPEC, even if we get any kind of, I guess, cohesive agreement, is it already being seen by the market as being too little too late?
Yeah, the concern is that it may not make a difference, and it's important that we're seeing West Texas Intermediate steady and come in right about 25 in electronic trading. But let's go right to the West Texas Intermediate 30-day chart, and this is after a wild day, Tuesday, because it began almost the same way with oil prices rising, but then falling 9%. So you had a 14.5% price swing just within the day. And you can see with that big plunge in West Texas Intermediate, it's down more than 66% year to date, and most of that decline has just come in the past few weeks. You see the same pattern with Brent crude oil. And again, what we're seeing hitting the market right now and really weighing on traders is that just as OPEC is about to meet Thursday to determine the specificity of an output curve deal, the U.S. released a report that slashed its 2020 oil production forecast, and this was by about 1.2 million barrels. So all of this coming, as we know the story, collapsing crude prices and plummeting demand that's threatening to shut down U.S. production. And we should point out that President Trump has gotten involved. He's tried to broker a deal between the Saudis and Russia, and many believe it's just not going to make a difference here.
So we're also hearing that perhaps 40% of U.S. oil drillers could go bankrupt. What's the story there?
Well, you have the Federal Reserve Bank of Kansas City putting out a survey, and the response was just abysmal. Almost 40% of the oil and natural gas producers pointed out that they'd be wiped out within the year if oil remains below $30 a barrel. A lot of the responses pointed out why the oil field is generally heavily leveraged, and so a lot of players just can't last with what's going on right now. As one put it, we can't continue to produce oil below the cost to produce it. One thing that's interesting to point out, again, we're going to get the latest inventory data Wednesday. It's expected to confirm the huge glut in oil supply.
Sue Keenan, thank you very much for that. Coming up next, Wuhan, the Chinese city where the coronavirus first emerged, comes out of lockdown. This is Bloomberg.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Daybreak Asia. I'm Karina Mitchell with the first word headlines. The coronavirus marches on, even as some nations report an apparent slowing of cases. New York State reported its deadliest day yet as global cases top 1.4 million with 81,000 deaths. White House economic advisor Larry Kudlow is striking an optimistic note, telling Politico that the U.S. economy may be able to reopen in the next month or so. He says plans are already underway for the post-virus world. The International Labor Organization says the coronavirus is having, quote, a deep, far-reaching and unprecedented impact on employment, with potentially 1 billion workers at high risk of pay cuts or losing their jobs. The ILO says lockdowns and shuttered businesses are affecting almost 2.7 billion workers, with hotels, food services, retail and manufacturing the worst hit. The airline industry is calling for a global set of virus-related health measures for when travel resumes to avoid the chaos seen after the 9/11 shutdown. IATA is warning against burdening carriers with red tape to guard against any flare-up in virus cases. The group says it accepts the need for safety, but operating conditions must be coordinated to ensure a smooth return to airline travel. And half the Japanese economy is entering lockdown amid a state of emergency and rising fears of recession. The government shut down 7 prefectures as coronavirus cases surge, with warnings that output may fall by as much as 20% in the current quarter. Prime Minister Shinzo Abe launched a stimulus package worth close to $1 trillion, as critics say he's been too slow to respond to the pandemic. Global news 24 hours a day on air and on Quick Take by Bloomberg. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Heidi?
Karina, China's lockdown of the city where the coronavirus first emerged ends today after more than 10 weeks. Wuhan now faces a long road to recovery, with AI data suggesting that economic activity is only at 1/3 of capacity and lagging well behind its peers. Of course, the rest of the country now mostly back to work. Our Beijing Bureau Chief Sharon Chen is in Wuhan now and joins us. And Sharon, you know, at the height of the lockdown, there was a real sentiment from people in Wuhan that this was a city and a province that had been sacrificed to save the rest of the country and, in fact, the rest of the world from the virus, right? How quickly are we going to see a recovery?
From what we've seen, you know, on the street, talking to people, talking to business owners, talking to factory owners, it's going to be a long journey back to recovery. Even though the quarantine is being lifted today, I mean, life is far from back to normal. A lot of restrictions remain. The green codes that people can access on their Alipay and WeChat apps basically govern all movement. You need to have a green code to get in anywhere, to get onto public transport, to get into malls, to get into restaurants, to get into work. And those codes can be really easily lost. All you have to do is come into contact with someone who has tested positive or displayed symptoms. And so everyone is not only worried about a second wave of infections, but also worried about being quarantined again. And everyone is being extremely cautious.
We had seen a lot of skepticism about the coronavirus cases and death numbers coming out of Wuhan. Do we have right now a clearer picture of where we stand now that the city is gradually reopening?
I think it will be a very long time, if ever, that we get a true, accurate picture of how many cases and how many deaths happened in Wuhan, although the problems that they had with accounting, a lot of other countries are facing as well. At the height of the outbreak, a lot of people didn't make it into hospitals, didn't get tested. You know, some people may have displayed symptoms, but never sought medical attention and then just recovered, or may have been asymptomatic. I think, you know, it's very difficult to tell what exactly the scope of the outbreak was.
Sharon, you know, we worry about complacency and you see the pictures of, you know, masses of people now returning as some of the key tourism sites in China reopen and Apple stores and retail are open again. But I'm curious to get more on what you're hearing on the street, because the psychology of being allowed back into the world is really interesting, right? Are you getting a sense that there's kind of pretty permanent changes to consumer behaviour and the way that people behave, and a reluctance or a fear that this isn't yet fully over and they could get reinfected if they went out in public?
Yeah, there's definitely been a change in consumer habits. I mean, one interesting tidbit is we spoke to some car dealerships, and they said that demand has actually been way better than they expected in just, the week that they've reopened. They've gone back to the sales that they were having in 2019, and the reason that's often cited is that people feel safer driving their own cars and not taking public transport. So they might buy like a second, cheaper car for a family member or for their kids. But, restaurant owners are definitely worried. Even with the lockdown lifted and people allowed to go to restaurants, we don't hardly see anybody eating out or gathering, or even in the malls, those have reopened and the stores are staffed with sales assistants, but there are almost no customers. People we talk to in the malls, very few people say that they still are only going to go out for essentials. And, there's been kind of a permanent change. People are going to stay at home more, keep to themselves more, just be more cautious of other people, at least, for months to come. Like, it's not going to be a flick of a switch once the lockdown is lifted. I think a lot of consumer habits have also changed because a lot of people were affected. They couldn't go to work for 2 months. A lot of people worry about their businesses, about their jobs, about their financial situations as well.
Right. Sharon Chen, our Beijing Bureau Chief, thank you very much for that. Of course, the impact of this pandemic, not only in China and Wuhan, but also pushing other emerging markets to the brink of economic crisis. Johns Hopkins Carey Business School professor Alessandro Rabucci telling us the extent of the damage is unprecedented.
We are very close. Emerging markets have been hit very hard by the initial phase of the crisis. We've seen massive outflow of capital from most emerging markets repatriating in the United States. The COVID epidemic is just picking up in emerging markets. As we know, it lasts for about 4 months, and the peak is for 2 months. And emerging markets are much less capable of absorbing the health dimension of the crisis. They will be put under extreme strain, and we expect to see unprecedented decline in economic activity and possibly widespread financial damages.
I'll go talk to him.
Professor, you are a world authority in real estate. It's something maybe diffuse, it's out there, it's not something we really can touch. How is the leverage within the global real estate system? Are they exposed as other asset classes were exposed in 1998?
At the global level, leverage in the real estate is not as diffuse and deep as in the United States. Typically, in emerging markets, real estate purchases take place on a cash basis. So from that perspective, leverage in the real estate is not necessarily the most important problem. However, research shows that impact in individual communities affected by pandemic can be extremely long-lasting. So certain segments of mega cities in emerging markets may be particularly damaged by the crisis, by the health dimension of the crisis itself.
We are sisters of the same cause.
Alessandro, can I talk a little bit about what is happening here in Europe? Italy finds itself in a very difficult situation. Its economy already sort of burdened with a huge amount of debt. It's likely to take on significantly more. What is your perception of the economic trajectory of Italy and whether or not its debt is sustainable?
Italy is in a particularly difficult situation because it was already experiencing difficulty to recover from the global financial crisis. Effectively, Italy never recovered from the global financial crisis, and growth was permanently hit by that shock. These new catastrophes will be extremely damaging for the and help is desperately needed from the European community, ideally from the rest of the international community. There is a lot of talk about options for financial rescue through European mechanisms. I think it is the time to consider emergency help from international financial institutions and chiefly the International Monetary Fund, which helped other European economies during the financial crisis.
Never take a step backwards in battle. So now I wear the colors of the rebellion.
All right, that was Johns Hopkins Professor Alessandra Rabucci. The Johns Hopkins Bloomberg School of Public Health is supported by Michael Bloomberg, who's the founder of Bloomberg LP and Bloomberg Philanthropies. All right, let's get you a check of the markets on this Wednesday as we head closer to that long weekend. Remember, a number of markets around the world will be closed for the Easter long weekend, but this is what we're seeing when it comes to Japanese markets. Nikkei staying firmly below 19,000. We are, of course, continuing to digest the implications of the state of emergency being declared. Fair to say, though, the muted market reaction suggesting maybe that some investors think that Japanese equities, the long-suffering market, has already seen a bottom. When it comes to the Kospi, we are seeing a halt to that 4-day gain there as well. Financials are weighing in particular. Moody's downgrading ratings across 6 Korean financial brokers, and we, of course, go into the BOK decision as well. Profitability concerns rising for Korean lenders, given that we have seen lagging loan demand and provisions also ticking higher in this environment as well. Take a look at Australia. Losses of as much as 2.5%. Of course, the big story there. Here, I should say, is S&P really lowering that outlook when it comes to Australian sovereign debt to negative from stable, maintaining that AAA, but a question mark over whether more downgrades could further come, given that we are seeing the RBA staying put where they are at the moment in terms of QE. We also are watching those banks as well. A lot of uncertainty over what happens to dividend for, in particular, Bank of Queensland, and Westpac also refraining from making a decision there. S&P futures, this is where we're seeing dollar edging higher there after the cut to the S&P Australian outlook weighing on that pair, and we are seeing the yen and Japanese bond markets holding pretty steady. Lots more to come on Daybreak Asia. This is Bloomberg.
In San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day
sizable moves in the currency market. Temperatures down half.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the First Word Asia.
U.S. and Japan duke it out over exchange.
China's slumping onshore bond market.